Yoojeong, and I'm joining you from Singapore today to update you on the Aberdeen Asian Income Fund, a total return strategy that targets the income and growth potential of Asia's most compelling and sustainable companies. From a style perspective, this fund is biased towards quality and value versus the benchmark, which positioned it pretty well during a volatile 2022, as the fund was defensive during a down market in Asia, whilst continuing to pay a very high dividend yield of 4.5%. The portfolio has 60 holdings or so, and the top 10 companies make up about 35% of the portfolio. Our largest absolute positions are in Singapore, Australia, and Taiwan, which unsurprisingly are the highest dividend paying markets in the region. Singapore in particular is a large position, especially relative to the benchmark, and that's really driven by the quality of companies we find on the ground in Singapore, protected by the regulator here in Singapore, but also because these companies have over time expanded into the higher growth economies in the neighboring markets such as Indonesia, Thailand, and also into China. On the flip side, the countries where we have limited exposure would be places like China. This is a market which has been dominated by high growth companies with low yields, such as the internet names, which we've avoided during the past couple of years. In sectors where yield is high in China, disclosures are patchy, and we found better quality companies elsewhere in the region. So for this reason, we hold banks across Singapore, Australia, Thailand, and Hong Kong as well. But we've chosen to avoid some of the large state-owned banks in China because we feel that on a valuation perspective, from a dividend perspective, and from a quality perspective, we can find better holdings elsewhere in Asia. Sector-wise, the top sectors within the fund are financials, information technology, and real estate. Banks in particular have benefited from rising rates, coupled with the removal of dividend handcuffs imposed during the pandemic by regulators. So that's been very positive for the fund. We also own some global leaders in the technology space, which are sitting on net cash balance sheets and paying a growing dividend every year. Turnover in the fund is around 20%. We're long-term investors and generally look to top up quality names that look cheap, whilst funding these by taking money out of companies that have performed well. For example, last year we saw some big special dividends from the Australian mining companies, so we collected these and then reinvested them into topping up banks across the region. I've mentioned some of the companies in Singapore, in Thailand as well, which we thought would be good beneficiaries of the reopening trade in Asia. Similarly, whilst our overall tech exposure remains the same, we've actually been changing the mix within our portfolio holdings. So we've been taking money out of the names that have done well and reinvesting these into other technology companies that have better dividend yield, as well as trading on better multiples, such as MediaTek and AEM here in Singapore. Whilst we have avoided a lot of the China market swings over the past 18 to 24 months or so, we're always looking for quality companies that we can add to the portfolio that gives us access to that consumer aspiration story in the domestic market. Given the drop in share prices, we initiated a Chinese internet company called Autohome, as we believe it was trading at an attractive valuation and gave us access to the market-leading online hub for car buyers and owners in China. Autohome's leadership in content also drives high-quality traffic, so their ability to cross-sell as well as generate revenues from ads as well as lead generation remains top in terms of the sector, and their parent, Ping An, is a well-known insurance company which provides good support for the cross-selling of financial products. Autohome has a net cash balance sheet and is a cash flow generative business, and we believe that this supports their ability to pay growing dividends in the future. Another example would be Auckland International Airport, or AIA, in New Zealand. This is an airport operator that's also a beneficiary of the reopening trade. And we continue to support AIA during the pandemic as they own assets that are really hard to replicate. And we believe that travel to this really quite beautiful region of the world would pick up again once the pandemic was over. Although they sensibly stopped paying dividends over the past 2 years, we think that dividends are about to resume. And in the meantime, during this period of lower traffic and lower business for AIA, we've been engaging with management on specific ESG issues to get more clarity around these as well. AIA, I think, is a good example because they have to tackle the climate change risk from different viewpoints. So we engage with them in terms of how they mitigate the physical climate risk of being a coastal airport that has to deal with severe weather disruptions as well as rising sea levels. But of course, AIA is central to the aviation industry, and so there is another aspect of climate change that we have to look at. And we were happy to see that these discussions and these improvements have been going on over the past 2 years as well. We're encouraged by their efforts to upgrade infrastructure during this time. And we've also been looking at the ways that they've been optimizing their taxiways and arrival paths, as well as setting up a ground power unit system, which lets aircrafts that are sitting at the gate access directly the New Zealand electricity grid rather than burning jet fuels whilst they're waiting at the gate. We've touched on this already, but what I think is appealing about investing for income in Asia is that dividends can be found across a very broad and diverse set of countries, sectors, as well as investment themes. So in this fund, we have exposure to the rising wealth of consumers and that middle class story here in Asia through financial products as well as retail themes. And we also invest in future mobility businesses. So we are invested in electric vehicle batteries here in Asia, where we get good growth as well as dividends from the likes of LG Chem, which is a Korean company. And we're also invested in the going green theme in markets such as India, where our investment into Power Grid of India, which is a central transmission network, that business is spending at least 20% of their new capital expenditure investing into renewable energy sources such as solar power. So I think a very broad range of dividend opportunities can be found in this part of the world, which makes it a more appealing way to invest into dividend and growth. The fund has recently paid the final quarterly dividend for 2022 for a total 10 pence per share dividend to shareholders, and that's a 7.5% increase year on year for dividends per share. This was a fully covered dividend as we benefited from the return of dividend payments by companies across Asia following the end of the pandemic. Revenue reserves are standing at just above 4 pence per share. That provides some buffer for future years as well. And the fund has a track record of 14 years of consecutive dividend growth, making it an AIC Next Generation Dividend Hero Fund. This is a title that we would very much like to continue, and we are also targeting an increase in dividend for full year 2023 as well.